Hi everyone, and thanks for joining us. I'm here today with Mark Willers, Acumentis commercial expert. Mark is the State Director for Commercial in our New South Wales team. And we're going to discuss some of the market changes that have been observed since the coronavirus pandemic. So Mark, it's clear to see that the impact of coronavirus is being felt across the globe, and the property sector as a whole is not immune to this. So there were recent government regulations that banned non-essential gatherings, which had the impact on auctions and open for homes. And these followed previous restrictions on closing places of public gatherings, so tourism, hospitality sector, in an attempt to prevent the spread. So there's no doubt going to be short and long-term effects felt across the commercial property sector. Are you able to share some of your observations to date with us?
Yeah, hi Amy, and hi everyone. I think based on our discussions with people active across the industry, we're really experiencing a pause at the moment across all markets, and how long that pause lasts for will determine the effects and the severity of the effect on the various different markets. Any effects are likely to vary across asset classes and sectors, and also between individual properties. And by that, I mean that properties on long leases with secure cash flows, good tenant covenants, and mid-term fixed increases will likely perform a lot better, may even see a small positive uptick in valuations when compared to properties in secondary locations with shorter lease expiry profiles and with a tenant profile that's likely to be heavily affected by any restrictions. Post-COVID, we seem to be seeing that supermarkets, pharmacies and retailers specialising in vehicle accessories, the construction industry and home entertainment, they seem to be trading very well. And a number of those have told us that their turnover has increased. Whereas food and beverage retailers and those focusing on luxury goods and travel and tourism, they've been hit the hardest in the first instance. I think it's fair to say that a more general and long-term slowdown will encompass a wider group of tenants being negatively impacted.
Right. And have you seen transaction volumes decreasing post the end of March when the government regulations were imposed?
Yes, we have. We've seen a marked decrease in transactional volumes since late March. A number of transactions that we've been involved with were negotiated prior to government restrictions coming in place, but there's really insufficient transactional volume at present to indicate any clear trends. We've seen some transactions proceeding at previously agreed pricing, some being discounted and others being postponed by purchasers looking to preserve their purchase terms.
And have you seen any examples of purchase prices that have been negatively or positively impacted?
Yeah, I worked on a transaction of a commercial asset in a Sydney fringe suburb. The property was sold by way of an expressions of interest campaign during March. It was backed by a strong tenant covenant, albeit on a relatively short-term lease expiry profile, but there was a plan to extend that leasing profile and do some reletting into the future. So generally speaking, seen as being a relatively low-risk asset in terms of its cash flow. The EOI campaign was shortened as the COVID outbreaks intensified, and there was a general consensus at the time that there was a marginally positive influence on buyer sentiment and the end pricing as buyers were seeking to put their money into a relatively low risk asset. We've worked on a mixed-use retail commercial property, also in a Sydney fringe location, where the purchaser is seeking to preserve terms by way of an option deed for 6 months and postpone everything. We're anecdotally aware of some regional fast food outlet sales proceeding at either previously agreed pricing or being marginally discounted. And we're also aware of a regional owner-operated service station being withdrawn from markets by the vendor and then re-advertised at a significantly higher price point, due mainly to increased fuel margins and profitability. So I think it's fair to say that there's a real mixed bag out there at the moment, and there's a lot of moving parts that are different for every property.
And are there any clear market trends emerging at this stage?
It's probably too early at this stage to base any trends on transactional evidence and to demonstrate any clear numerical trends, as we just don't have sufficient transactions. However, we do appear to be seeing the availability of debt funding decreasing for some assets and some sectors, and there's definitely a wait-and-see approach to investor sentiment at the moment, which is preventing sort of large-scale numbers of transactions.
And do you think that there are factors that will arise from this health crisis that might change the market moving into the future?
Yeah, I think it's fair to say that for the large parts of the workforce, working from home arrangements have actually gone quite well. And I think as a result, we may see an uptick in the office space available for sublease over the short to medium term, which may then flow on to higher vacancy rates. In the short term, I think any return to more normal working arrangements are likely to be staged, which might mitigate any excess space available as employers look to give each employee more space and occupy at a much less dense ratio. Also, as corporations look to cut fixed costs to do with rents off their balance sheets, this will probably positively impact those providers of flexible office space as employers seek to use their arrangements. We may see capital expenditure trends emerging here as building owners look to upgrade things like air conditioning, filtration, and also maybe stairwells so that tenants can use them and relieve some load on the base building lifts to prevent them becoming overcrowded. We've already seen some owners refurbishing foyers and bathrooms and making the most of having empty buildings over this period of work from home arrangements. In the retail sector, probably too early to say. Some of those tenants and areas will be hit for quite a long time and in quite a severe downturn. I think it's fair to say that some of the retailers might want to be exposing themselves to smaller footprints in future. Maybe we'll see food and beverage retailers seeking outdoor space and fresh air. There might be some redesigns of some of that space coming up. Any negative impact on the retail sector is likely to be far worse in some geographic areas than others, particularly those areas that focus on food and beverage retailing or luxury goods that rely on overseas travellers. We might see an increase in voluntary administration being used across all sectors, particularly for those companies that entered this period without large cash reserves. And it's also fair to say that we are likely to see some unexpected and unintended trends emerging as a consequence of large government stimulus packages now entering the market, and we'll really have to wait and see how those emerge.
Yeah, right. Well, some great insight there. Any sort of summary comments on the market and where you think we might be headed? Yeah,
look, I think at the moment, every asset needs to be considered on its merits, and really every property needs a tailored approach to try and figure out what its relative, positive and negative points are in this market. Some more general positive comments around the marketplace. There's still funds available to place in real estate. There's still latent demand out there for real estate, and although we're seeing a wait and see approach, at some time that will free up. And we're in a very low interest rate environment domestically, which is a positive, and the Australian dollar is very favourable to overseas purchases. I think valuation fundamentals are going to be very important moving forwards. And by that, I mean that tenant covenants, lease expiry profiles, mid-term reviews, property location, all of these things are going to be very, very important. And we're likely to see a concertina effect that we've seen in other downturns, where secondary assets with a lower tenant covenant profile and those tenants that are highly exposed to restrictions, those assets are likely to see much heavier discounting than their prime counterparts. We've already seen some owners gearing up in readiness for perceived opportunistic purchasing in the future. So owners getting facilities ready to buy. And if there's a weight of funds being invested into markets in the future, when that level is seen, when we get to those opportunistic levels, we may then see a V-shaped recovery depending on the weight of funds that are injected. And look, to wrap up, I just want to reiterate that at the moment, every asset's different. Every asset needs looking at on a very individual basis. And we've got a team of highly experienced experts here, and we're more than willing to have a conversation. If you've got any real estate needs, if you've got any need for advice, then by all means feel free to call us, and we can help as best we can.
Thanks, Mark. Some really great insights and valuable information on the impact that coronavirus is having across the commercial property sector. So thanks for your time. And just reiterating Mark's words from the team here at Acumentus, we want to let everyone know that we're here to support you through these challenging times. So you can reach any of our team on 1300 882 431. And we're going to continue these conversations and sharing insights across our different property market sectors with you. So thanks for tuning in, and keep a lookout for our next conversation, which will be coming soon. Thanks, Mark.
Thanks.